Right, there we go. Hey, we are live, and I'm totally prepared. Hey, I'm Darcy Ungaro, and Mark Fowler, Rupert Carlyon. Thanks for joining me, Mark Fowler, head of investments with Hobson Wealth. Rupert Carlyon, genius behind Kura KiwiSaver. How you doing today, guys?
Very well, thanks, Darcy.
G'day,
Fantastic.
Darcy. It's very kind of you. You've obviously had a good day to be talking so effusively.
Yeah, well, no comment. But we were just the reason why we're kind of laughing, just so that people are watching, they understand what the background is Rupert's camera was upside down, and the irony is that we're talking about inverted yield curves, and so to demonstrate, Rupert was demonstrating what an inversion looks like at his face. So that was good. But we're going to be talking about an inverted yield curve. What does it mean? And this is a really interesting thing. It's kind of like reading tea leaves. Does it really mean that something is going to happen? And it's important to us, right? Because if we are borrowers, if we're property investors, or just regular investors, the interest rates often influence the performance of the markets. So if something is out there and it's telling us that, hey, there might be some downtimes ahead, maybe we should actually talk about that. So you guys cool to talk about that today?
Cool.
Sounds good.
Sweet. So who wants to go first in terms of defining what it means, and maybe even break it down word by word? Yield. What are we talking about when we say yield? And then therefore, what is a yield curve?
Mark's the fixed
Yeah, look,
interest.
yeah,
Hand this
no,
whole conversation over to him.
no, just certainly happy to cover that. I mean, look, yield and often interest rate is sort of interchangeable, if you like. So if you think about a bond as an investment, you often see something quoted as a yield to maturity, and that's effectively the annualized return that you'll receive on that investment. So if it's got a 3% yield to maturity, you're going to earn 3% annualized on that investment. And I guess why there's so much emphasis on the yield curve or the interest rate curve is just that sort of forward-looking predictor of where interest rates may go. And I think it's important to note that there's no guarantee of it. It's certainly forward-looking and it's an indicator, but it's not necessarily mean that's the way it will play out. And I guess when we talk about an inverted curve, the really interesting thing around that is when you think about investing over a longer period of time, portfolio theory tells you that if I'm investing out for a longer period of time, I should get a higher rate of return. So you have what we call a positive sloping curve. So if I'm going to invest for 1 year, I receive 2%. If I invest for 5 years, I should receive 4%. And if I was going to invest for 10 years, I want to get 6%. And we describe that as a naturally positive sloping curve. Whereas an inverted yield curve indicates that actually, if I invest out longer, I'm actually going to get less of a return, which again it's quite hard. It's not intuitive. And I guess what that's basically saying is, the market believes that, to your point, Darcy, there's some unsettling times ahead.
Right. So it's kind of, in a way, it's like a navigation system in a way, right? Where it's saying not turn left here and turn right here, but it is kind of saying the direction of which things may go, which is informed almost by a bunch of investors kind of voting, in a sense, what they believe the future environment will look like, and therefore by extension what the interest rate environment will look like. Is that right?
Absolutely. Yes.
Okay.
And look, an inverted yield curve has actually been a very strong predictor of a recession. As I say, there's no guarantee that it's going to be a recession, but it has been a strong indicator in previous economic cycles. And I think what we've seen recently, particularly in New Zealand in the last 6 months, is this really aggressive amount of pricing that's gone into the market. And borrowers certainly seen that through mortgage rates, almost a sort of doubling in mortgage costs, and literally in the space of 6 months. And I guess an inverted yield curve also suggests that they don't think there can much more can go into the market, and therefore the next move is likely that certainly the Reserve Bank pausing, or in some cases maybe 18 months down the track, maybe even needing to unwind some of those interest rate hikes. So it's a really interesting sort of indicator in that sense.
Yes, it's kind of almost like a source of truth, right? Independent of the action and the words that we hear coming out of regulators, like coming out of the Reserve Bank. It's another reference point outside of that to cut through any of the other incentives that might be functioning, right?
Correct.
Okay, no, that's cool. Now,
Just quick question, sorry, out of curiosity. And then the shorter the curve is. So if we're saying So if, say, for example, it was 2 and 5s that became inverted, so at the moment it's 2 years and 10 years that are inverted. If it was 2 years and 5 years, or even, God forbid, 1 year and 2 year, then you know there's a real problem, right? Does that kind of, as the certainty of a recession increases, does the inversion become earlier and earlier on the curve, or is that completely wrong?
No, not at all. And I think that's exactly right. I guess the only difficulty too then, because things are so forward-looking, is you can also get, and to really confuse matter, you can get a curve that bows, if you like. So exactly to your point, Rupert, they think, hey, the recession is upon us. We're going to be cutting rates the next few years. But then again, you'll get to the bottom of that cycle, and then they'll have to start raising interest rates again, and that will be reflected in more longer-term rates. So you're exactly right. You know, the inversion on the point of the inversion on the curve often reflects the time frame as well, or the perceived time frame.
Yeah, we tried to do a model the other day showing prediction using the 10-year, the curve to predict OCR rates over a kind of 5-year period, and we just managed to confuse ourselves heavily.
Yeah. And the other thing that's confusing is it's not a guarantee. It's an indicator, and it's been a pretty good indicator over the years. But as you say, it's not necessarily means the way it's going to play out either.
So the press is spending a lot of time talking about 2019, and at the moment being the last time the yield curve was inverted. I kind of racking my memory. We were nervous that we're at the peak of the cycle back end of 2019, but there was no talk of recession or anything like that.
Mm.
No, look, exactly right. But do you remember there was quite a lot of talk around negative interest rates and the need for that. So I think there was some of that being reflected in the fact that, hey, look, you know, curves, even though we were historically at very low levels, there was a feeling that, hey, things could go negative, and that was really sort of confusing, I think, interest rate markets at that time as well. And I actually remember the deputy governor from the Reserve Bank New Zealand coming out and saying, we're not bluffing on negative interest rates, we're just trying to give the banks time to get their systems in order. So I think it was sort of slightly before that period, but that was a real sort of thought process at the time.
So it was so strange though, because I remember that around that period of time. It was August, September. I remember doing a bit of a deep dive with, I think it was Jeremy Couchman from Kiwi Bank, one of the economists there, around negative interest rates, and it was all around that, and it's so strange that shortly after that, I remember there was also some issues in the U.S. around the repo market, and
Yes.
then lo and behold, we had this COVID thing happen, and then everything obviously is history from there. But it's just so weird how sometimes preceding these major events, you see these little weird indicators go off, and it doesn't necessarily say what it is that's going to happen, but it's almost like the market tells us something. Am I making this out to be something more than what it is? Because it's a bit weird how it works.
No, look, I agree, Darcy. And I think at the moment, you know, a bit of a buzzword in financial markets is stagflation, you know, this idea that, you know, we're getting inflation without growth. And I think that's also a big driver of this at the moment, is this fear that central banks will be too aggressive to try and combat inflation. And if inflation sort of normalizes, then we're suddenly at levels that doesn't really reflect the growth of the economy. And so, hey, they might have to unwind this sort of aggressive interest rate hikes that we're really seeing. And I think that's the real risk too around consumption for the economy in the next 12, 18 months is, I think something like 60% of all mortgages are being repriced this year in New Zealand. So, you know, you've got that sort of lag effect now, but, you know, what does it look like in 12, 18 months time when you've had a double in your servicing costs and those sorts of things? So, yeah, I think there's a couple of really key factors which is driving those, driving that inversion.
So the stagflation argument's an interesting one, right? Because I mean, this year, what the US will still do 4%, New Zealand will do kind of over 3%. There at the moment, there don't seem to be any impediments to growth. We still have unemployment across the world at long-term lows. There just seems to kind of, that's the bit again I kind of go, and I'm kind of confused at the moment by a lot of the messaging, and particularly around some of the market movements, because it just feels as though, and we still see companies reporting strong earnings. I get that supply chain, oil, commodities, there are quite a lot of, and interest rates, there are a lot of headwinds out there. But actually, at the moment, what we're seeing is we are seeing economy still going on all cylinders. Or am I missing a whole big piece here?
No, I think you're correct. I mean, if you look at our GDP numbers and those sorts of things, they've been pretty robust, all things considered. As you say, we've got a very tight labour market. So I think unemployment's at 3.2%, which is you know, a historical low. And to your point, there's reasons for that. So look, I don't think it's a sort of hit the panic button just yet, but I think it's just more around the lag effect of COVID, if you like, and what will that be like in 12 months' time as opposed to as in the here and now, and look, I think that's still yet to be answered.
Cool. Hey, can one of you, I'll let you guys fight amongst yourself as to who does this, but what I'm showing on the screen for those that are watching is the 10-year treasury maturity minus the 2-year treasury. So this is taking the yield, which is a return, taking the yield on the longer term minus the yield on the lower term. Can you explain to me what that means when we see it plotted out like this?
Yeah, so that well, I mean, if you don't mind me answering, Darcy, but that'll be basically reflecting the spread, what we call twos tens. So basically, and that oscillates at any time between the economic cycle. So as I say, when you if you think you're sort of embarking on a hiking cycle, which means you're embarking on hiking interest rates, that spread between 2 years and 10 years should be quite wide, because it's suggesting that they'll continue to raise interest rates, and so therefore that you get that twos tens spread widening. Alternatively, if you're at the end of a tightening cycle and that you think the next move is needing to be down, then you should see that converge quite dramatically. So ultimately, as you see at the moment, we've got slight inversion, which indicates that, hey, everything that's priced into the market is pretty optimistic, and in actual fact, there's a real sort of thought process now that we won't get to anywhere near those levels, and so that spread contracts.
The other thing that's important to point out, all things being equal, you should get paid more for having your money locked up for longer. And so that's kind of the core premise, right? If today, if we expect things to stay exactly the same, the fact that you're willing to lock your money up for 10 years versus 2 years, 10 years, you should get paid more. And I don't know what that long-term premium is, but that kind of might be anywhere from 50 to 100 points, so from 0.5 to 1%. So actually, this is a pretty extreme move when you take that into context as well.
Good point.
Exactly. Yeah, and often inversion doesn't last long. So that it's quite a single point in time, and then you see the market sort of exactly what Rupert said. Because if you think about it, it just doesn't make sense, right? Unless you really believe in an extended period of a deflationary environment. So if you look at somewhere like Japan, which has had deflationary pressures for decades now, you see these really flat interest rate curves because people believe that there's no inflationary pressure or there's no real sort of growth there. But in a more normalized sort of developed economy, absolutely, you should always be paid for taking that extra sort of what we call risk premium.
Yeah, so it's return on the risk that you're taking, plus it's a term premium, right? Like you're losing access to that money for a period of time. So if you're getting a really low rate of return instead for the longer, it means that something's a little bit strange, right?
Yeah. So you go to term, I mean, for everyday people, right? You remember we go to the bank, term deposits, you lock it up for 5 years versus 3 years versus 1 year, you get much better rates on the 5-year money.
Yeah, that's a good way of putting it. And so, and we have, it's not like this is new. And again, the reason why this is so important to talk about this is because of the, a lot of us are borrowers still, and maybe we have investment properties. And so that really affects cash flow, and also it affects markets. So what I might show just for fun, just for giggles, is I might show something, because this is something that I tell a lot of people when talking about mortgages and how long to fix their mortgage for. My view is that it's way more about risk management than it is about speculating on where interest rates are going to be going. So one of the examples that I often use is this period of time that we saw in 2007. So this is right before the GFC hit our shores here in New Zealand. And this chart here shows us what a 5-year interest rate was costing in what would cost in December 2007. Looks like it was right on 8.9%. So if you were a borrower in December 07, let us know in the comments if you were paying more or less than 8.9%. But that was the 5-year rate. And then the other rate, which is quite interesting, remember that 8.9 figure, is on the 1-year rate. It was closer to, I think it was 9.55 or 9.5, I think was the 1-year rate for quite a decent period of time between November and January. So more expensive than the 5-year rate. So the short-term money was more expensive to borrow than the long-term money. And that was an example of an inverted yield curve. Now, did we see a crash in the property market? Not really, but it definitely went flat. And in some areas, it definitely pulled back in 08. But what's interesting here is that very soon after, people often fix for the cheapest interest rate possible. And so a lot of people locked in for 5-year money and then found out that 6 months later, interest rates had gone down by half. So that's kind of indicative of what can happen. So in other words, if nothing else, an inverted yield curve tells us, hey, just be careful and actually think a little bit about what you're doing, right? You don't know where it's going to happen, but it flushes out a lot of weirdness. Any thoughts on that?
Yeah, look, I think, and I think that's really relevant for right now, Darcy. I mean, my view is, you look at some of the sort of 5-year rates on offer at the moment. I think they're sort of just under 7%. So not a million miles away from some of those numbers we're talking about pre-GFC. So to my way of thinking, I'd really caution terming my my borrowing out for too long, because if you believe the inverted yield curve as a good indicator, there's a very real possibility that that those rates come down. So look,
Yeah.
and that's the way we're looking at it for our bond investors. We're sort of saying now, hey, on the other side, what we would be doing is really looking to invest in that 5-year spot, because we think if mortgage rates come down, your yield on your bonds will come down also. So you want to lock in those higher rates as an investor, and obviously it's the inverse for a borrower. So yeah, look, that's certainly our view at the moment.
Interesting. Yeah. So actually, Rupert, sorry, go ahead, Rupert.
Yeah, I think it's an interesting one. That is a great. Sorry, but look, there's a great question that's come up, which has raised this big second question for me, which actually I've been meaning to find someone. And Mark, you will kind of have a view on this. The question is, would they phase out fixed interest rates? The thing that I have never understood is why are variable rates so much higher than 1, 3, or even 1 year very short-term rates from the banks? Is it a marketing ploy and getting people fixed in? Is really the reason why variable is so unpopular is because it's a way to make sure that banks can't let people move. Being a true skeptic from my side.
No, look, I'm a firm believer in that. I mean, I'm probably as cynical as you are, Rupert. No, look, because if you look across the ditch to Australia, and bear in mind, the 4 majors here are Australian, Australian banks. You don't see that distortion in the variable rate to the same extreme as you see in New Zealand. So it is quite unusual. It's quite a sort of nuance to our market. And yeah, look, I've actually, I've written a couple of articles about it in the past over the number of years, sort of saying, how do the banks really kind of justify these high variable rates, relative to the fixed rate mortgage market? And really, other than sort of defending, movement between banks and holding on to customers, I think it's a difficult one for them to justify.
Yeah.
And I mean, one of the things, when you get me on a rant now, but one of the things that I spent a lot of time buying and selling banks in one of my previous lives, client apathy is the most profitable product that a bank will ever make. And so a mortgage client from a bank who forgets to refix and just let it slide into variable and sits there, or has a lazy kind of extra couple of $100,000 in their excess, that kind of becomes highly, highly, highly profitable for the banks with these variable rates. And so to me, variable rates are really important because if anything, they play on a little bit of the inertia of customers.
Yeah. And I guess from what I see in terms of helping people out with their mortgages, it does seem to be a thing that it's also kind of tied into the Reserve Bank and how much influence they have. Because if interest rates were really cheap on the fixed rates, again, just looking at history, there was times like this for a long period of time where the floating interest rates were significantly higher than the fixed rates. And during those periods of time, the Reserve Bank, in my view, was relatively impotent. They couldn't actually exert any influence at all through the mortgage channel anyway, because it doesn't matter. They can raise the OCR up to 100 for all we care. We're sitting on fixed rate mortgages that have another 3 years to go. So I guess there's also that as well. And so if there was a phase out of fixed interest rates, in a way, that would definitely increase the influence of the Reserve Bank which would, in theory, make it a lot easier for them to influence rates of inflation much more quickly, right? Because like what you were saying before, Mark, there's this lag that happens when people eventually come off their fixed rates. So you can't quite see the impact right away. And if you're trying to deal quickly with this cancerous inflation, you kind of need to be quite surgical about it. And fixed rates probably kind of get in the way of that. You know what I mean? It's my thought anyway. But how about we kind of pivot a little bit here, and I want to get your opinion, maybe to start with, Rupert, because just for fun, I want to know where you think interest rates are going to go, because I kind of have a feeling I know what Mark's going to say, I think, but I want to know what you think. And let's talk just in the context of mortgages to start with. So in the next, say, 1 to 2 years, what's your feeling and why?
Look, I think we're on a knife edge, to be honest. And part of me goes, look, we've got very low unemployment. We've got inflation, which seems to be getting higher and higher every day. We've got supermarket. It's just kind of how much of it's transitory. I'm not convinced that it's still transitory. It should have passed through by now. So look, I'm struggling to see a case where interest rates fall at any time soon. However, will we get as much growth in interest rates coming through as predicted? I mean, in the US, what are they saying now? 9 interest rate rises over basically the next year. Look, that'll just be devastating. But it's kind of really hard to see where it goes. That again, it comes back to the paradox that I'm facing in my own mind with everything in the markets at the moment. 3.2% unemployment, kind of almost double-digit inflation. Something has to be done. And the other bit that's really concerning is a lot of market commentators are talking about protecting the credibility of the Reserve Bank and central banks, which is about as uneconomic an argument as you have ever had. But fundamentally, that means that these guys have turned themselves into politicians, which means you can't really kind of trust them on the economic answer either.
That's well said. Yeah. Keep going. What comes next?
I'm not sure where. I think unfortunately, probably what that does mean is they do go higher and they move quicker than probably is smart. But I don't think that's going to be for the right reasons.
Yeah, interesting perspective. Like I know from where I sit, I've had to kind of remind myself a few times, hey, interest rates increase to combat inflation. That's why interest rates increase. Interest rates don't increase to combat house price inflation. It's the CPI inflation that it's trying to deal with. So you can't kind of look at it and think, well, no one wants the housing market to crash, therefore they can't crank up the interest rates. Like there is a logical argument because of the flow and effect from the economy as a result of that, but it's not as simple as that. What do you think, Mark? Like what's your view on in the next 1 to 2 years in particular, in light of that yield curve thing that we've been talking about today?
Yeah, look, I think the banks have got a huge role to play, because if you think about mortgage rates where they are now, in theory, they are factoring in an OCR at 3.5%, because that's what the market has now priced. So if you took it from a purely theoretical spot, the Reserve Bank could raise rates another 10 times at 25 basis points, and the mortgage market shouldn't move. Okay, because what they're saying is that's already priced in there, and the mortgage market has led. The banks have led to take that into consideration. But I think what we all know is if they were to be quite aggressive and continue, the risk then is the market will move to price more, and therefore the banks will raise mortgage rates higher, and they'll take that opportunity to do that. And that, I think, is a really key point. I think the other thing I agree with Rupert in terms of inflation not being so transitory anymore. But another thing to remember is that on an annualized basis, if inflation is running at 7% over the last 12 months, as we progress, those numbers fall out on an annualized basis, and it has to be replaced. So you have to get 7% on 7% to remain at 7%, if that makes sense. And I don't think you'll see that. I don't think you'll see inflation sustained at this level. So I do think it's more entrenched, but I think you'll see over a period of time some normalization back towards what we deem sort of 2 to 3% in that range. I think they're quite key factors. So I think the bank does have a big role to play, and I think I totally agree with Rupert too around the knife edge. If you think about banks, what makes up their assets is predominantly retail mortgages, and if they squeeze their client base, if you like, around serviceability, then that affects the price of housing, and so they walk that fine line, don't they? And I think the last thing I would put in there is I think you need to see quite a big response in terms of wage inflation. So I think it's one thing to have a very tight labour market, but if you're not getting paid any more this year than you did the previous year, in actual fact, that cost to serve gets even more difficult. And I think what we haven't seen in New Zealand, which has really been a low wage economy for a long time, is that pass through. And I think again that plays a big role. So look, that's
do we think we're going to start to see that? I mean, anecdotally, you're starting to see a lot of stuff around that. You're seeing, I mean, the 3.2% unemployment. You're hearing more and more stories, whether it be in our industry. Admittedly, our industry is as far from normal as it gets, but even talking to some business owners in kind of South Auckland that run factories, where there's a lot of people jumping ship for an extra $1, $2 an hour. It's pretty easy to find that right now if you're willing to kind of be brave and move.
Yeah, and I think your point is well made, and I think it does depend a little bit around sectors. I mean, I think if you're if you're in tourism or hospitality, and obviously it's been an incredibly difficult time, and for those sort of sectors, it's about probably getting back on your feet and those sorts of things. So look, I do think within different sectors, there's certainly inflationary pressures on the wage side, but is it enough to keep up with the rate of of rising costs, which seems to be everywhere? I'm not sure. So look, my view is interest rates are going higher. There's no doubt about it. But I'm just not convinced the Reserve Bank will get to an OCR of 3.5% as quickly as they may think they are going to. I just think you'll start to see economic data turn in the second half of this year, and I think that will be quite a large factor in their thought process.
I guess that's the weird thing about this, right? You've got the demand side, and then you have the supply side. Supply side, supply chain shortages, all that sort of stuff contributing towards it. Shortages on the labor, that might push things up on one side. But then on the demand side, we've had this certain amount of momentum that's been building in us because of this almost artificially fueled rampage of optimism from cheap and free and new available credit that's spurring us on. And what's that, sorry?
That's what you really think.
I'm holding back, trust me. But if we kind of think about that, it's like I can kind of see this already, though, that sentiment, the thing that does kind of get triggered on the demand side, that sentiment can change very, very quickly. And you start saying negativity out there like a lot. Hey, the world's on fire with geopolitical risk and supply chain shortages, and COVID's not gone yet. After a while, people kind of start to sit on their hands, and they might actually start to sit on their money. And then you have a money circulation problem, which then probably deals to that inflation thing, I guess, organically, naturally, like probably what we should be doing. Do you think that almost the settings or the speech out of the Reserve Bank talking the market down by saying we're going to be really aggressive with 10 more hikes to bring it up to 3.5, do you think that's almost a little bit too full on in light of that psychology piece? Mark, what do you think of that?
Oh, look, I think sentiment plays a huge role in markets, and look, already we're seeing a dip in business confidence and consumer confidence, and I think they do. They walk a very sort of tight line, and look, unfortunately, they changed their view quickly too. As I say, 15 months ago, they weren't bluffing on negative interest rates, and now we're going to an OCR of 3.5% in the next 12 months, and to me, that messaging has changed very, very rapidly. Sure, there's been reasons for that, and their modelling does suggest. But look, if you look at the RBA, so if we look at the Reserve Bank Australia across the ditch, they held the line again yesterday, and they still have effectively a zero cash rate. And they've been far more patient around the fact that they're happy to look through some of these short-term pressures. Sure, they don't have inflation running at the best part of 6% annualized. These are sort of closer to 4%. But they've really taken the opposite view, more your view, Darcy, about, hey, let's just sort of make sure we're back on a firm footing post-COVID, and then, hey, maybe we do need to raise interest rates quicker than we thought. But they're taking that sort of opposing view, and I guess my concern is they have been very much on the front foot, and there's don't seem to be letting up. And I think once that confidence and that sentiment piece turns, that tap can go off very quickly.
Yeah.
And look, just hearing anecdotally now, auction clearance rates in Auckland and Buffett and Thompson it was 80% pre-Christmas. Now we're hearing it's around 30%.
Those that actually make it to auction as well. A lot of the money that are getting pulled well before they get to auction. So that's a flattering number. A little bit like
and so you think about that sentiment shift in the space of 6 months. So I think, and look, I'm sounding very negative here. I think I'll walk back from the edge of the cliff, but I guess it's just sort of outlying. I think there are a number of risks, and I have been surprised that Adrian Orr hasn't been a little more circumspect, even just in his rhetoric. But I guess he feels as though they're looking at their models, and it suggests they've got to get going in a hurry.
Do you think there's a possibility, though, that maybe we've gone a little bit too far down the path of thinking that interventionism is the cure to keep us safe from market downturns?
Yeah, look, I think, sort of, it's almost like central banks don't want an economic cycle anymore. God forbid a business goes to the wall, or there's some mortgagee sales because people have overextended themselves at the wrong part of the cycle. And I think we've seen that, sort of post GFC, whenever there seems to be some sort of crisis, then it's monetary policy support and the cavalry arrives, if you like. So this is the first time in a long time where maybe we don't feel as though that sort of, let's call it the Fed put, didn't they? It's almost like the Fed put's disappearing, and we're not really quite sure how to cope with it.
That's right. Interesting, eh? The parents are drinking too much and they're not responsible anymore. What are us kids going to do, right? Who knows?
I think the other analogy is the mollycoddling might have stopped. The mollycoddling might have stopped, and we might let the kids finally grow up and learn their own lessons.
Fair enough. I know, and maybe that's probably the right thing, right? Like, and I know that's easy to say until you feel it, but it's just a reminder, I guess, that when you're investing, it's a two-sided coin, and unless you're willing to look at that dark side and factor that into your plan and how you think about your investments, you got to be really careful, because when you see the other side of that coin and it is a pullback, people often think during the good times they're all good, but when it actually happens, they learn for the first time, actually, they're not that cool with risk. So maybe just to finish up on, should we just talk about investor attitudes towards risk and just being truthful with ourselves? Because you guys are both in the funds management space, in different spaces, of course, but do you see this as a recurrent theme that people initially think that they're all good with risk, or they say they are, but then you learn later on that actually, now they're selling at the worst possible time? That tells us maybe they're not cool with risk. What maybe start with you, Rupert, like in the context of KiwiSaver, what do you think?
It's definitely. I understand the theory. I will do what I...
Sorry, Rupert. I put you on mute there. Sorry, do you want to say that again?
Sorry. Look, I think 100% I agree with you there. Investors will always say, I'll be fine, I'll be fine, I'll be fine. They always think, no, I won't panic. I know I'm not going to be one of those people. Until they see their balance is 20% down, and then that's straight to the fight or flight reaction, and they have to do something. So I do think it's very much 100% very hard for people to predict how they're going to behave until they get into that situation.
Yeah, well said. And Mark, like if you were to say something to investors, and we're not saying, hey, a correction is definitely coming, but we know that it absolutely will at some stage. It always does. What would you say to investors out there right now when times are actually not that bad? What would you say to them to prepare them for the inevitable?
Yeah, look, I think exactly to your point, Darcy, you're always going to see economic cycles, and you're always going to see investment cycles. And I guess the thing that, that we certainly try to convey is that, we're always long-term investors. And we believe that, we believe in long run sort of equity market returns and bond market returns for that matter. So I guess the difficulty is just identifying those who just really aren't comfortable with any sort of volatility. And to Rupert's point, if you wake up one morning and your portfolio is down 20%, and you don't like the side of that, then that can be really difficult to sort of get that message across. And look, let's face it, it's always easy to say that when your capital isn't at risk. But I think the overarching theme that we try to emphasize is, we've got a lot of empirical evidence now over a long period of time that suggests, over the cycles, long market, sort of long run returns for investors is something that's always been positive, and we continue to think, you buy good businesses with good management, with good prospects, and that story never changes.
Yeah. Well said. No, that's awesome. So there you go, guys. Hope you all enjoyed that. Remember, just to email through some questions. If you have any questions, you can email me, darcy.ungaro@nzeverydayinvestor.com. Probably should have got a shorter email address, but fire through some questions. We actually were keen to cover off the Air New Zealand rights issue, as well as talk about Elon Musk buying a good chunk of Twitter. But we definitely want to cover that. And so we will be releasing another show on Monday to cover that for those that want to learn more about that. And trust me, we're not going to be covering the stuff that other people have said we'll tackle this originally. So hope everyone enjoyed that. But if you do have any questions, feel free to fire them through. Mark Fowler from Hobson Wealth, Rupert Carlyon from Kura KiwiSaver. Thanks for joining me tonight.
Thanks, Darcy. Thank you very much.
Thanks, Darcy. Thanks,
Cool.
guys. Cheers, Rupert.